Hello and welcome to this special programme on July's US jobs report. The headline non-farm payrolls figure is expected to come in at 165,000. We'll also be paying close attention to any revisions to last month's reading. Meanwhile, the unemployment rate is expected to come in at 3.6%, and of course that all-important average hourly earnings figure is seen hitting 0.2% month on month, 3.1% year on year. Let's get a check on the equity markets as we enter those final hours of trade for the week in Europe. European markets are caught up in a major sell-off across global markets, triggered by Donald Trump's announcement of fresh tariffs against China. The German 10-year Bund yield hit a new record low. As you can see there, the DAX and the CAC both down by more than 2.5%. Here's a check on US pre-market action ahead of the equity open in just over an hour's time, and it looks like the major averages could extend yesterday's losses after the Dow swung from a 300-point gain to a 300-point loss into Thursday's close after Trump's tariffs spooked the markets. We saw the biggest two-day rally for US Treasuries since May, with the benchmark 10-year yield shedding 18 basis points. Safe haven assets catching a bit as well, the likes of gold and the yen. Meanwhile, oil sold off sharply to the tune of around 8% on WTI. Let's have a check now on the major US dollar crosses. It's a relatively muted day for the greenback compared with the volatility that we saw around the Fed earlier in the week, with the exception of dollar yen, which is trading notably lower to the tune of 0.5% in the red amid risk-off sentiment spurring demand for the Japanese currency and that flight to safety trade. But of course, plenty of investors likely taking to the sidelines as we await that all-important jobs report. Joining me on set today is IG's senior market analyst, Josh Mahoney. Josh, good to see you. Now, how much weighting do you think this report really can have on the markets, given that we're having this major sell-off? It really seems as though the Trump retaliation and the tariffs is what investors are truly focusing on right now.
Yeah, and that's definitely the case. This is certainly setting us up for a period where the likes of the US and China are sort of seemingly heading towards this final eventual ramp up in terms of tariffs. And this time it sort of feels like it might actually happen in terms of this final 300 billion. But certainly that's sort of a major backdrop. I guess to an extent that's already been sort of worked out by the markets. We've already seen significant reactions by the markets. I guess this also comes at an interesting time. Generally, if you see a jobs report coming before a Fed decision, and you would know that that's going to be able to impact it. Instead, we're getting it like a couple of days after the Fed decision. And therefore, everyone's kind of thinking, okay, well, is this going to shift the mentality of the Fed going forward? And certainly the Fed certainly wasn't necessarily as dovish as Donald Trump would have hoped, and instead pointing towards this phase of easing as being relatively fleeting and temporary in nature. It's something that I've been highlighting for some time now, the fact that this isn't 2008. This isn't a time where we need to see, time and time again cuts to the interest rate. Yes, this whole idea of like insurance cuts from the Fed does make sense, given that we were seeing a slowdown. We're seeing much higher rates there compared to many of the other global economies. But certainly it made sense that it was going to be relatively brief. But this figure today, or these figures today, should in some ways give us a sort of lead in terms of, are the Fed sort of overcooking it in terms of thinking that actually the economy is already recovering, and should we start seeing the Fed actually taking actions and taking stronger actions going forward? I think that by and large the numbers are probably going to be pretty decent enough to say for the Fed to carry on the rhetoric that they've sort of said earlier in the week on Wednesday, and so really the backdrop to this is going to be, what are the Fed thinking? And I don't think there's going to be a huge shift on that front.
All right, now what's kind of the key number in the report that we should be focusing on? Often there's the knee-jerk reaction when it comes to the headline jobs figure, but often a lot of investors focusing on the wage figure when it comes to the Fed. I know you mentioned that we had the Fed meeting before. Nonetheless, the central bank will be keeping a close eye on wages and what that could mean for future inflationary pressures.
Yeah, certainly. And this is particularly notable at the time because of the fact that, ultimately, if we saw inflation really dropping off really heavily, then the Fed's going to have to act. We saw core PCE rising pretty sharply recently, and that gave us a lead to think actually inflation's not necessarily too much of a worry for the Fed. of course, today's average hourly earnings figure is going to be along those same lines. It's going to give us a lead in terms of what the trajectory of future inflation is, and that, of course, gives us a lead on what the Fed's going to be thinking in the future. So certainly that's going to be a really important number. Of course, by and large, like you said, people generally react to that payrolls number first.
All right, we've got the numbers. They've just come through. It's 164,000 for the headline non-farm payrolls figure. So that's a touch lighter than expectations. Meanwhile, average hourly earnings coming in 3.2% year on year, 0.3% month on month. Now, in terms of the unemployment rate, 3.7%, so a touch worse than expected. Broadly, I'd say this is a report that's come in line with expectations. Last month's non-farm payrolls figure for the month of July was revised to 193,000 as well. But just to recap, the headline 164,000 versus forecast for 165. So pretty much bang in line there. Josh, what are we seeing in terms of the market reaction?
Yeah, I mean, you're seeing the likes of euro-dollar tick a little bit lower, so that's euro-dollar strength. Now, ultimately, that sort of points towards, you're saying we're seeing sort of worse unemployment rate figures. Market expectation was for a better unemployment rate figure. The headline number on the payrolls number, relatively close to expectations. So whilst this isn't like, a number that's going to blow it out the park and all of a sudden say, right, the US economy is brilliant and we're creating, 300,000 kind of thing. What it is a number that's, the whole Goldilocks issue, right? It's good enough. And it's not something that the Fed's going to look at and think, right, we need to really act off the back of that. So it's somewhere in the middle. It's not necessarily super bad so that it's going to push the Fed. It's not something incredible. But certainly I think it's enough for people to think it's not going to necessarily change the mind at the Fed.
But it's interesting because this year we've had quite a lot of volatility in that headline numbers. We've had some major misses to the downside and then some very big beats. And I just think that's kind of a consequence of the fact that we are towards full employment. And now this number has come in line with the expectations. So I think the key number really is that wage figure, but that has indeed come in line with expectations as well. So nothing too much really for the Fed to worry about there.
Yeah, exactly. And like you're saying, as you go further into the recovery and as you reach sort of so-called full employment, you're going to see those headline numbers not necessarily as, blockbuster as the numbers that you've seen in years gone by. That's to be expected. And certainly, markets are aware of that. They're not necessarily treating this like this is a particularly weak number. And so, yeah, I don't think necessarily too much changes from this. And that means you go back to what the Fed outlook was, and that was not necessarily hawkish, but not necessarily uber dovish, and therefore you're likely to see upside in terms of the dollar off the back of that. I mean, I'm looking at gold at the moment. I guess you would think off the back of that you would see gold coming off somewhat. We're not necessarily seeing that. We're actually seeing gold moving towards the upside. A lot of this is really going to be associated with the fact that we saw this massive rally. We've seen this pullback, but that's associated with the fact that we've of course got this whole US-China trade war that's likely to play out over the next month. I think interestingly on that front, you've got the proposal to ramp up tariffs on the 1st of September. They hadn't planned to actually meet again until some point in September. So that's certainly something that should provide upside for gold, even though that whole story about this massive sort of bout of easing around the world seems to have faded somewhat, with the ECB holding off, the Fed now not necessarily as dovish as we would have thought. So
it seems as though there is quite a lot of nervousness in the markets at the moment, and that's why we're seeing that risk-off sentiment prevail. I mean, we've seen the rally in the yen, we've seen the rally in the gold, Swiss franc bonds as well. I mean, is all this selling just a knee-jerk reaction to what we're seeing from the tariffs, or could this be the start of something more sinister?
Look, I mean, it's one of those things where people look at, your yield curves or your treasuries and things like that, and everyone starts thinking, actually, if you look historically, it looks like we're about to have a recession around the corner.
The inversion, of course.
Yeah, and generally it doesn't necessarily happen. And, I would say that, the US economy is not as bad as we thought. We're now starting to see, actually, over the last month, that we're seeing decent enough figures across the board for the US economy. Certainly there are some weaknesses, and the whole US-China thing, despite the fact that Donald Trump will make you believe that the US is doing great out of all of this and it only hurts China, it hurts both sides. So we're much better in an environment where everyone's able to trade freely. And certainly, in terms of this market volatility, that's likely to be around as long as Donald Trump wants to keep having a battle on a number of different fronts from a trade perspective.
So if that's the case, then the sell-off that we're seeing in the major averages stateside, does that arguably provide an attractive bullish entry point?
Potentially, I don't think it's necessarily over quite yet, just because this is relatively fresh news to the markets. You know, it's something that I was saying, you know, in terms of the whole US-China thing, you have sort of 3 states. You have one state where they've finally made a breakthrough and it's completed and they've got a deal. That never seems to come. You have this current state that we're in now, which is basically everything's potentially off and we're going to ramp up tariffs, and then you've got the sort of middle ground, and the middle ground is generally where we trade, where we've been trading. That's why you've seen stock markets constantly rise, because despite the fact that you've got the US-China sort of threat over your shoulder, as long as they keep saying, you know, we'll have talks next month, you know, we'll meet again, then people don't worry about it too much. It's just when something like this happens and all of a sudden they say, right, we're going to slap you with a massive tariff, that's when you see markets sell off. But that generally doesn't necessarily last too long. So further weakness, I mean, this is the Dow at the moment. You can see we're trading around about that 264.33 low that we've had from around about the back end of June. The fact that we've broken through this 266.57 mark points towards further weakness. You can see trendline resistance coming into play here. So I do expect to see further downside. We could see a rebound. So, you know, it comes down to whether we break this 264.33. If we do so, we're looking at the moment like we're essentially retracing part of this rally from 246.02, and therefore there is a potential for a sort of more widespread period of downside to come into play. But like I said, soon enough, whether it be from the Chinese side or the US side, they're likely to try and avert that ramp up in tariffs. And if that comes to fruition, then all of a sudden you've got that sort of somewhere in the middle scenario that I was describing, and then you're likely to see the bulls come back in. But I think for the short term, I think we're likely to see further downside. All
right, now let's just recap the numbers once again. It was 164,000 for the headline non-farm payrolls figure for the month of July, compared to expectations for 165, a touch lighter than expectations there. 0.3% was the month-on-month average hourly earnings figure, 3.2% year-on-year. The unemployment rate a little bit worse than we were forecasting, 3.7% versus expectations for 3.6%. That's all we've got time for today. Thank you so much to my guest, IG's senior market analyst Josh Mahoney, and thank you for watching IGTV. I'm Victoria Scholar, and have a lovely weekend.